Imagine this. You're scrolling through your portfolio in late 2026, watching your investments soar while the rest of the world is just waking up to the opportunity. What if I told you the most explosive stock market plays for the next year aren't some secret insider tip? They're staring us right in the face, fueled by unstoppable global shifts. As we wrap up 2025, with AI reshaping industries, green energy mandates accelerating, and economic recoveries gaining steam, the smart money isn't waiting for fireworks. They're building positions quietly today. In this video, we'll dive deep into the sectors poised to dominate 2026, backed by real trends, historical patterns, and forward-looking data. I'll reveal why timing matters now more than ever, how early birds have historically turned modest bets into life-changing gains, and a game-changing strategy at the end that could redefine your approach to investing. Stick around. Missing this could mean leaving serious money on the table. Hey everyone, welcome back to Finovo, your go-to channel for cutting through financial clutter with actionable insights on money, markets, and building lasting wealth. I'm your host, Alex Rivera, a seasoned investor with over 15 years in the trenches, from navigating the 2008 crash to capitalizing on the post-pandemic boom. Today, we're zeroing in on 2026, the year analysts are buzzing about as a potential inflection point for massive growth. Remember, this isn't personalized financial advice. It's about spotting macro trends that every forward-thinking investor should monitor. We'll explore data-driven predictions, real-world examples, and practical tips to help you position yourself wisely. If you're new here, hit that subscribe button and turn on notifications. We drop fresh content weekly to keep you ahead of the curve. Let's jump in. Let's set the stage. History teaches us that the biggest market rallies don't wait for front-page news. They ignite in the shadows, 12 to 24 months before the mainstream catches on. Think back to the dot-com era or the 2020 tech surge. Early investors who spotted the signals multiplied their wealth, while others chased a hype too late. Fast forward to now, in late 2025, we're seeing a perfect storm brewing. Central banks, including the Fed, are signaling interest rate cuts stabilizing around 3 to 4%, which historically unleashes pent-up capital into growth sectors. Add to that the explosive AI adoption. Global AI spending is projected to hit $200 billion by 2026, according to recent McKinsey reports, driving efficiency across industries. Then there's a green energy push. With the Paris Agreement commitments ramping up, governments are pouring trillions into renewables, creating a ripple effect on supply chains. Global supply chain realignments post-COVID and geopolitical tensions are favoring onshoring and diversification, boosting domestic manufacturing. Economic indicators like rising GDP forecasts for major economies, e.g., U.S. at 2.5 to 3% growth, and declining inflation point to a soft landing turning into a takeoff. But here's the unique angle. Unlike past cycles, this one is intertwined with climate tech and digital transformation, creating hybrid opportunities that could yield asymmetric returns. If you're not positioning in 2025, you might miss the boat. Data from Bloomberg shows that markets price in future earnings 18 months ahead on average. So what does this mean for you? It's time to think like a chess master, anticipating moves before they're obvious. Artificial intelligence has evolved from buzzword to backbone. By 2026, it's not just tech. It's the invisible force rewiring every sector imaginable. We're talking about AI integrating into healthcare for personalized medicine, finance for fraud detection at lightning speed, logistics for predictive supply chains, and even education through adaptive learning platforms. The market size? PwC estimates AI could add $15.7 trillion to the global economy by 2030, with 2026 marking a key acceleration phase as adoption hits critical mass. Focus on the unsung heroes, AI chipmakers like NVIDIA or emerging players in specialized semiconductors, which are seeing demand skyrocket with data centers expanding globally. Cloud computing giants, such as Amazon Web Services or Microsoft Azure, are scaling AI infrastructure, with revenue growth projected at 20 to 30% annually. Don't overlook automation software firms. Think UiPath or Automation Anywhere that streamline operations, reducing costs by up to 40% for businesses. What makes this unique? In 2025, we're witnessing a shift toward ethical AI and edge computing, where devices process data locally for faster, more secure results. Companies pioneering this could see explosive valuations. Smart investors aren't betting on the next ChatGPT hype. They're buying into the picks and shovels of the AI gold rush. For instance, historical parallels. Investors who grabbed Intel shares in the early PC boom saw 10x returns. Today, diversification here means blending established names with niche innovators, like those in quantum computing tie-ins. Keep an eye on regulatory tailwinds too. EU's AI Act could standardize the field, favoring compliant leaders. The green revolution isn't a trend. It's a trillion-dollar mandate reshaping our world. By 2026, with net zero pledges from over 100 countries intensifying, we're on the cusp of a massive demand surge for sustainable tech. Electric vehicles, EVs, are leading the charge, Global sales are forecasted to reach 20 million units annually by then, per IA data, driven by falling battery costs, down 85% since 2010, and incentives like the U.S. Inflation Reduction Act extensions. Battery storage is a hidden gem. Companies innovating in solid-state batteries could solve range anxiety, powering not just cars, but grid stability for renewables. Solar and wind infrastructure? Expect explosive growth as costs plummet. Utility-scale solar is now cheaper than fossil fuels in many regions, with installations projected to double by 2026. Unique twist. The intersection of AI and energy, like smart grids using machine learning for efficiency, is creating hybrid plays. Think firms like Tesla for integrated ecosystems or Enphase Energy for microinverters optimizing home solar. Governments are fueling this with billions in subsidies. China's dominance in rare earths is shifting, opening doors for Western suppliers. Investors who jumped into renewables post 2015 Paris Accord saw portfolios green up significantly. Early entry now could mirror that. But beware volatility. Geopolitical risks like supply chain disruptions add edge, so focus on diversified ETFs or leaders with strong moats. This isn't just about saving the planet. It's about profiting from inevitable change. As we emerge from the rate hike turbulence of the early 2020s, financials are primed for a comeback. Interest rates stabilizing in the 3 to 4% range by mid-2026 could spark a lending renaissance, boosting net interest margins for traditional banks like JP Morgan or Wells Fargo. Fintech disruptors, think Block, formerly Square, or PayPal, are revolutionizing payments with blockchain integrations, capturing the shift to digital wallets amid e-commerce growth projected at 15% CAGR. Global economic recovery, with IMF forecasting 3.2% world GDP growth, means more loans, mergers, and wealth management fees. Unique insight. The rise of decentralized finance, DeFi, and CBDCs, central bank digital currencies, could blend old and new. Banks adopting these might outpace laggards. History echoes this. Post 2008, financial stocks like Bank of America delivered 5x returns as uncertainty cleared. Today, add cybersecure platforms and AI-driven risk assessment for an edge. Emerging trends like embedded finance, e.g. buy now, pay later in apps, are expanding revenue streams. For investors, this sector offers dividends and stability. Yield averages 3-4%, making a hedge against volatility. Diversify across regions. U.S. giants for strength, European banks for value post-Brexit recovery. The key? Patience. Financials thrive when fear fades, and 2026 looks like that turning point. While Wall Street hogs the spotlight, the real growth stories are unfolding in emerging markets, where demographics and digitization are turbocharging economies. By 2026, rising middle classes in places like India, Brazil, and Southeast Asia, projected to add 500 million consumers, will drive demand for everything from smartphones to fast fashion. Infrastructure giants, such as those building high-speed rails or 5G networks, stand to benefit from belt and road-like initiatives. Consumer brands adapting to local tastes, like Unilever's regional expansions, could see sales explode. Local market leaders in e-commerce, e.g., Mercado Libre in Latin America, are mirroring Amazon's playbook but with hyper-local twists. Unique angle. The friend-shoring trend, companies relocating supply chains to allies like Vietnam or Mexico, is creating manufacturing booms, favoring industrial stocks. Data from the World Bank shows EM GDP growth outpacing developed markets at 4 to 5% annually. Historical winners? Early bets on Alibaba pre-2014 IPO turn modest, sums into fortunes. Risks like currency fluctuations exist, but ETFs like Vanguard's Emerging Markets Fund mitigate them. Tie in tech adoption. AI and agriculture for yield boosts or fintech for in-bank populations. This isn't gambling on frontiers. It's strategic exposure to the next billion consumers, potentially delivering outsized returns for diversified portfolios. Now, let's get tactical. Chasing shiny objects leads to pitfalls. True wealth comes from disciplined, trend-aligned strategies. Start with fundamentals. Seek companies with robust balance sheets, positive cash flow, and moats like patents or network effects. Align with long-term megatrends. Allocate 30 to 40% to AI/tech, 20 to 30% to green energy, 15 to 20% to financials, 10 to 15% to emerging markets, and the rest in defensive plays. Diversification isn't just spreading bets. It's layering across geographies and asset classes. Mix stocks with ETF for broad exposure. Time in the market trumps timing. Dollar cost averaging smooths volatility, as studies from Vanguard show average annual returns of 10% over decades. Unique tip. Use scenario planning. Model best/worst cases for 2026, like AI breakthroughs versus regulatory hurdles, to stress test your portfolio. Incorporate ESG factors not for virtue, but value. Sustainable firms often outperform. Tools like robo-advisors, e.g. Betterment, make this accessible. Remember, psychology matters. Avoid FOMO by setting rules, like rebalancing quarterly. This approach isn't flashy, But it's proven. Warren Buffett built his empire on boring bets compounded over time. Adapt it to your risk tolerance and consult pros if needed. Wrapping up, the path to 2026 prosperity isn't about get-rich-quick schemes. It's about informed, patient moves that compound into something extraordinary. If you're tuning into these trends now, congratulations. You're playing a long game like the pros. Thanks for watching Finovo. If this sparked ideas, give a thumbs up and share a friend who's investment curious. Subscribe for weekly deep dives on everything from crypto trends to retirement hacks, and hit the bell for instant updates. In the comments, which sector excites you most for 2026? AI, green energy, or something else? Drop your thoughts, and I'll reply to as many as I can. Remember, knowledge is your edge. Stay invested, stay informed. See you in the next one.